So December 2023, question 1B. It explains what we've been talking about when we say that it's not our role to prepare the financial statements of a company. That role is for the accountant. As you can see, the accountant has already prepared the income statement of this business. In preparing this income statement, the incomes ameziweka pamoja ndio hizi, expenses pia ziko hapa. So in arriving at this loss of 2689, there are some incomes that were added here, which are not supposed to be there. There are some expenses that were deducted here, which are not supposed to be deducted. And any further information is here. So let's see. Asili and Tulivu established a partnership business sharing profits and losses in the ratio of 3:2 respectively. The following statement of profit or loss of the business for the year 2022 was provided. Sales are okay. Sales are for the business, so that you have no problem with. Gain on sale of shares. Remember our points to note. Tulisema gain on sale of capital items are non-taxable income, so lazima tutoe hiyo. Foreign exchange gain, it was unrealized. For it to be taxable, it has to be realized, so lazima tuitoe hiyo. Recovery from insurance on stolen stock. I believe that one we said it's taxable income, insurance compensation on revenue items. So that one, it's at the right place, tutaachana nayo. Then we have discount received, that is an income, just as we said. Dividends from Wakaguzi Cooperative Society. So for tax purposes, we have to separate incomes from different sources. So dividends are income from investments. They cannot go together. They have to be removed from the business. Zitakuja as other incomes. So tutaitoa kwa biashara, tuipeleke kwa other incomes. We'll see how to deal with it. So on the side of expenses, we have purchases. Purchases are for the business. We have purchase of computers. When we buy computers, we don't take it to the income statement, we take it to the balance sheet. So those are things that accountant use to steal from KRA. When you buy fixed assets, they belong to the balance sheet, they don't belong to the income statement. So that one, disallowable, tutaipeleka kwa balance sheet. What should come here is the capital allowance on computers. Accountant should bring in here depreciation. Sisi kama watu wa tax tunaleta capital allowances, lakini badala ya kuleta depreciation analeta hata cost ya computer yenyewe. That is wrong. Partners' salaries, remember what we said, there should be no transaction between the business and the partners. So this one we shall add back, disallowable. Legal fees, we need to know what kind of legal fees they are. I can see note number 5 is explaining them. Repairs and maintenance, that's a genuine expense. We must repair and maintain the business. So we must repair and maintain the business. Then we have rent and rates. Rent and rates, there's a genuine expense that we have to pay. We have to pay rent for the business. Interest on loan, the loans that we take attract some interest, we have to pay them. So those are genuine expenses that we cannot run away from. General expenses, we cannot run away from them. Kumbuka si general bad debts, ni general expenses. General bad debts do hatutaki. Motor vehicle expenses, genuine expenses, we have to incur them. Insurance, we have to pay the insurance. Preliminary expenses, pre is before. So the expenses that you incur before the business starts operating, that cannot be a genuine expense. Remember, an expense should be associated with the income. Expense for 2024 against income of 2024. So expenses that we incurred before 2024, they are not for this year. So it's on disallowable. Directors fees, support tumekuwa na directors. When you see something like this, then it should knock it should give us a concern. This is a partnership. Partnership doesn't have directors. Partnership ni partners. So most likely, this partnership was converted into a company so that directors' fees inakuwa allowable. Audit fees, we have to pay the audit. Debenture interest. Debentures in themselves, they're capital related. So interest on debentures will also be disallowable. Interest that is allowable is the interest on loan. And we allow assuming that the loan was used to finance the operations. But debentures, tukua debentures za kuinvest. So the interest on the interest on loan to invest is always capitalized. Like for instance, if I take a loan to buy a motor vehicle, I go to the car yard, the motor vehicle costs 2 million, and I do asset financing. The interest that I pay on that loan is maybe 500,000. In my books, the cost of motor vehicle should be 2.5 million, not 2 million, because the interest is capitalized. Then we have traveling expenses that should be okay, and they arrived at the loss. Now, additional information is always explains what is in the income statement. So let's see. Purchases and sales of goods were inclusive of VAT at the rate of 16%. VAT is tax. Taxable income can never be affected by tax. So tunafaa tutoe hiyo VAT. What does that mean? That the purchases and sales are overstated by 16%. We need to remove the VAT. When purchases are overstated, profit is understated. When sales are overstated, profit is also overstated. Remember the rule? Opening stock and purchases, indirect relationship, inverse relationship. Closing stock and sales, direct relationship. Closing inventory was valued at 55.20, while opening inventory was 10% of sales net of VAT. No problem. The partnership was converted into a limited company by the name Asili Limited on 1st April 2022. So it was a partnership for only 3 months. Nikakuwa kampuni. Income and expenses accrued evenly throughout the year unless otherwise stated. Legal fees comprised notice for change of business name. So the legal fees you incur, I think we didn't mention it under the legal fees that are disallowable. Among the legal fees that are disallowable, if you have space, you can also include the legal fees relating to starting of a business. Legal fees relating to starting of a business, i.e., preparation of partnership deed and MOU, Memorandum of Association, MOA. Preparation of partnership deed and MOA, Memorandum of Association. Hizo zote ni capital, kwa hivyo ni disallowable. So change of business name, you're disallowable, it's capital. Conveyance fees of business premises, that is transfer of property, tulisema ni disallowable. Stamp duty must have been incurred relating to the transfer of business premises, kwa hivyo itakuwa disallowed. Acquisition of business loan, the fee of, tulisema legal fees relating to raising money from any other source, apart from issuing of ordinary shares to the general public. Hiyo tu ndo allowable. Zingine zote ni disallowable. So this one, acquisition of business loan becomes disallowable. What is allowed for a loan is the interest on loan, not the cost of getting the loan. Then of course, recovery of bad debts that should be allowed. Signing a 99-year lease agreement that should be allowed. I think that one we said up to 99 years is allowed. Purchase of Asili's private residence, that is private, kwa hivyo ni disallowable. Appeal against tax assessment. Tax appeal tulisema ni disallowable. Anything to do with taxation, tax matters, cost that you incur to sort out issues with taxation, yote ni disallowable. Repairs and maintenance comprise purchase of furniture. Furniture is fixed asset. When we buy furniture, we don't take to the income statement. Unfortunately, they bought furniture and they included the cost of furniture, the cost of new sign, the cost of office block, and the painting of new office block. They are part of the repairs and maintenance, meaning those items are in this figure. So they were deducted as expenses, which is wrong. So you have to add them back. So then we have general expenses, registering of patents. Patents are fixed assets, kwa hivyo pia ni disallowable. Negotiating for additional land. Land ni fixed asset, disallowable. Interest on loan includes interest on partners' capital of 300 and was shared according to the profit and loss sharing ratio. So hiyo pia inakuwa disallowable. Nice. So they want us to prepare a statement of adjusted taxable profit or loss for the year for Asili and Tulivu and for Asili Limited Company. Then schedule showing that. Great. So let's try answering this. So they are called Asili and Tulivu and Asili Limited. And Asili Limited. Of course, it's 2022 taxable income computation. Now, circumstances under which a partnership is dissolved. This is one of when one partner dies, when a new partner joins, when one partner retires. They also have their own independent decision. Like in this case, they just decided to convert it into a business. So the partnership came to an end. So you have two businesses during the year. So you have a partnership for 3 months. So you have a business that was there for 3 months and another business that was there for 9 months. So for 3 months, this was a partnership, Asili and Tulivu partnership. And for 9 months, Asili Limited. We can have some 2 columns. Shillings. Then these are the side, shillings and shillings. Kill 2 birds with 1 stone. Can even something like that can work for us. Great. So let's see. The figures are in shillings. Now, at this point, we start from reported net loss. Just as I said, it is not our responsibility to prepare the financial statements. Hiyo ni role ya accountant. Ashatutengenezea akatupea loss ya 2689. So we apportion it accordingly. That's why we are told incomes and expenses accrued evenly throughout the year unless otherwise stated. Give me a minute. We can so we can continue. So we start from the reported loss. Washatutengenezea income statement, it's 20, that amount. But now we have to apportion accordingly. So for the 3 months, we have times 3/12. So 3/12 times that one. So we have that. Then this one for 9 months, 9/12 times 2689, 600. So you have the one for 6 months and you have the one for 9 months. So we just apportion accordingly vile iko. So from the reported profit, we now add back. In arriving at that, there's some expenses that were wrongly deducted. So we add back, they're called the disallowable expenses. So we start with additional information. Number one, purchases and sales were inclusive of VAT. So purchases were overstated. If purchases are overstated, profit is understated. To correct that profit, we add back because iko less, imekuwa understated. So here we add back VAT on purchases. We add back VAT on purchases. And our VAT on purchases, I believe, if they're inclusive of VAT, then you should be talking about 16/116. So 16/116 times, how much is our purchases? 8526,000. So we need to add back that VAT. For the 3 months, so 3/12 times that one. For the 9 months, 9/12 times the VAT. Then VAT. So if it's inclusive, that means it's not 100%, it's 116%. So what is 16%? 16/116 times that amount. So that is the VAT on purchases. Then wakatuambia sales pay iko na VAT. So meaning sales are overstated. When sales are overstated, profit is also overstated. To correct, we less. So I want us to kill 2 birds with 1 stone. Hakuna kurukaruka, unaacha space ya kutosha. Just leave enough space. Huku tunakuwa na kuless. And we can start by lessing VAT on sales. VAT on sales. So 16/116 times, how much is our sales? 2184,000. That is our VAT. So we apportion accordingly. So hapa tuko na 3/12, 3 months over 12 times that VAT. Then we have 9/12 times the VAT. So hiyo tutaless. So we continue and see. So note number 1 you've sorted. Note number 2, closing inventory was valued at that, while opening inventory was 10% of sales net of VAT. Hawajasema iko na shida, kwa hivyo iko sawa. Unaachana nayo. They have no issue with the closing and the opening stock. They've just mentioned how much they were. So that one, we have no problem with it. The partnership was converted to a limited company by the name Asili. That's why you have 3 months and 9 months. No problem with that. Income and expenses accrued evenly. That's why we are portioning. No problem. Legal fees. Notice for change of business name. We need to add it back. So notice for change of name. For change of name. So notice for change of name. The notice was there before the company came into place. So that notice came to convert a partnership into a company. So there's an expense that affects, it did not accrue evenly. It came in because of the company. So that's an expense that goes directly to the company. The business name, why are we changing the business name? Because we were making this partnership into a company. So that's an expense that is for the company, not for the partnership. Hapo ndo penye walituambia unless otherwise stated. Hapa, unless otherwise stated. So you didn't change the business name for the company. We changed for the partnership. We changed the business name for the company. So that expense is not accrued. So the whole 194,400 inaenda kwa kampuni. Conveyance fees of business premises, the same. Conveyance fees. Conveyance fees. We also, conveying is like transferring. The cost of transferring the business, it came because of the company, not the partnership. So the entire 217,200 inaenda side ya kampuni. It did not affect the partnership. Stamp duty, we can also assume stamp duties for the transfer of property. So it also goes to the company, not for the partnership. Stamp duty is 394, 349, 800. So that is for the stamp duty. Acquisition of business loan. So business loan, we can acquire it even as a partnership. So that one we apportion accordingly. So acquisition of business loan. So that one you have to apportion accordingly. At a partnership inaweza loan. So this one, 3/12 times the total cost for the acquisition of business loan is 62,400 times 62,400. So this other one is 9/12. But 6,800. So you just be creative and analytical. Is this expense for the business alone, or is this expense for the partnership? Can this business touch both partnership and the company? If the answer is yes, you apportion accordingly. Is it only for the partnership? Deal na partnership. Only for the company? Deal with the company. Recovery of bad debts, that's a genuine expense, so you have no problem with it. Signing 99-year lease agreement, you have no problem with it. That is a genuine expense for the business. Purchase of Asilis private residence, that's a disallowable expense. So Asilis residence, so that can affect both the partnership and the company, so we apportion accordingly. Asili was there as a partner and was also there as a director. So for 50, apportion accordingly. So 3/12 times 450. So that is for 3 months. We do the same for 12 months. For 9 months, it's 9. So we are adding back the disallowables. Appeal against tax assessment is also disallowable. So tax appeal. Hata partnership inaweza kuwa na issues za taxation, so you apportion accordingly. So 3/12 times 246,000. So that other one is 9/12. Great. Then you look at repairs and maintenance, comprised purchase of furniture, walieka kwa repairs, the fixed asset. So you have to add it back. So, St. Francisca. Iko sawa? So you have the purchase of furniture. Sorry, so furniture, we apportion accordingly, 288. So 3 months, 3/12 times 288,000. Then for 9 months, 9/12. So 9/12 times 288,000. The same scenario for new sign. New sign, the same. Three over 12 for the new sign is 180,000. That is 45,000. Then this other side is 9/12. I hope I'm not so fast. We're able to follow. They are fixed assets, they should not be allowable, but accountant allow. Designing office block. So design, that's capital related, 1170,000. So 3 months, 3/12 times 1170,000. Then we have 9/12 for the 9 months. So 9/12 times 1170. Painting new office block. New office block is not repairs and maintenance. As long as it's new, that is part of construction. Painting new block. Ingekuwa old block, ingekuwa repairs and maintenance, that will be a genuine expense. So you have 3/12 times 67,200. Then hiyo ingine 9/12 times 67,200. Nice. Then general expenses, registering of patents is also disallowable. Patents are fixed as intangible fixed assets. Registration of patents. Patents are intangible fixed assets, so they are disallowable. 336,000. So 3/12 times 336,000. Hiyo ingine ni 9 months. So 9/12 times 336,000. Negotiating additional land for business expansion. Land negotiation. That's capital related. They have not said for the company, even as a partnership, we can get more land. So that is 3 months, 3/12 times 168,000. Then we have 9/12. 9/12. And 9/12, we have it there. Then interest on loan includes interest on partner's capital of 300,000. So interest on partner's capital, we should also add back. Tulisema ni disallowable. Na hiyo ni ya partners, kwa hivyo ni ya partnership. It only affects the partnership, not the business, not the company. So 300,000. So we are done with additional information. We go back the income statement kwa expenses. Tuone kama kuna ingine ya ku-add back. Purchases, tusha adjust. Purchase of computer. So we need to add back also computers. They are disallowable expenses. We purchased computers at 550. Even as a partnership, we can have computers. So for 3 months, 3/12 times 550,000. 540, sorry. 540,000. Then for 9 months, 9 over 12 times 540. Partners' salaries, we need to add back. Salary to partners. It's a disallowable expense. There should be no transaction between the business and the partnership. Hiyo ni a partnership, so 2160,000. That's an expense for the partnership alone. Legal fees, we've already taken care of it. Yenye iko kwa additional information usiguze tena. Repairs and maintenance iko kwa additional information, shaishughulikia. Rent and rates ziko allowable. Interest on loan iko sawa. General expenses iko sawa. Motor vehicle expenses, they're okay. Insurance, preliminary expenses, we add back. Preliminary expenses. Now the preliminary expenses are the expenses you incur before the business starts operating. The business that was almost starting to operate was the company. So this can be the preliminary expenses for the company only. So that is 788,400. That is for the company alone, because pre is before the business starts operating. Then we have director's fees. That's an expense that is genuine for the company. Audit fees is okay. Debenture interest, we need to add back. Si kama space yako imeisha. Yenye uliacha ya expenses za add back. So debenture interest. For you to take debentures, you must be listed at the stock market. Partnerships are never listed. Companies are listed. So debentures hizo ni za kampuni tu, 180,000. You cannot issue debentures if you're not listed, and you cannot be listed when you're a private entity. Partnership is private entity. So tushamaliza na expenses za add back. So we shall get the totals, tuzilete hapa, the totals tuzilete hapa. You can allow me to add with Excel. So we have it there. So these are total. Sorry. So this total ni hiyo. Hiyo ndio inakuja hapa. So we add back the disallowable expenses. So let's see what to less. Kwa additional information ya kuless VAT tumeless. Rudi kwa incomes zetu. We need to less gain on sale of shares. Gain on sale of shares. Shares don't belong to the partnership, shares belong to the company. So hiyo ni income side ya kampuni peke yake, 156,000. Just being creative and being analytical. Ukiwa shares are for the company, not for the partnership. So you cannot put for the partnership. Just the same way debentures are not for the partnership, debentures are for the company. Then we have foreign exchange gain was unrealized. So this one you have to disallow, non-taxable, unrealized forex gain. So because it's unrealized, it's not a taxable income, toa kwa biashara. So even as a partnership, we can transact with foreign customers. So this is 3 over 12 times for 50,000. Then this one is for 9 months. Recovery from insurance on stolen stock, that is okay. Discount received is okay. You also need to remove the dividends. Dividends from wakaguzi. From wakaguzi. Cha muhimu hapa ni cooperative society. So the 153,000 for 3 months. hata partnership inaweza kuwa imeinvest kwa cooperative society. That's why we apportion 153,000. This is for 9 months. Then we're also supposed to less something called capital allowances. Capital allowances. Zile assets tulinunua zote ziko na capital allowances. Zingine tulizi add back kwa sababu walikuwa wameziless kama expenses. So zile assets tulibuy zote tunafaa sasa to less the depreciation part as far as taxation is concerned. So let's check them out. We have purchase of furniture. So you have furniture. We also have new sign. What else do we have? Office block, we only designing. We shall claim capital allowance once the office block is complete. So you cannot claim anything for now. We had something that was bought. Computers ziko hapo juu. Computers. So you have computers. Sioni kama tuko na fixed asset ingine tulibuy. So now there's a leakage in as far as our unit is concerned. Na iko hapa juu. It's always in every sitting. So this is the schedule for capital allowances. So I wanted us to put the figures first of all before you go there.